Hello everyone, welcome to this session. This session will talk about the different types of accounting system like a single entry and double entry system. So let's understand what is a single entry system and what is a double entry system. So basically the single entry system of accounting is where only one aspect of the transaction is recorded. Now basically what happens when a single entry is actually followed by the entities, by a normal common man or a small entities which do not keep a full-fledged accounting. Let's say for example, they have incurred 5,000 rupees for movie expenses. So that has been just noted or recorded as movie expenses. So they only consider what is the expense which is actually made. So this type of transactions, what we call as a single entry system. Now single entry system generally used by small, as I mentioned, small businesses, and which is very easy to, but it is not a complete way of recording. The second type of accounting system is actually called as a double entry system. Now double entry system considers both income as well as the expense aspect. Now what is the logic behind the double entry system is every transaction has a two-side impact. Okay, for example, if the rent is paid by cash, there is an effect on the rent and also the effect on the cash side. So the double entry system considers both aspects of the accounting, both aspects of the transaction for accounting purpose, and this is considered to be the accurate one. Now while preparing a double entry system, so double entry system is based on the principle of every debit is equal to every credit or every credit is equal to debit. So first that is the basic business. Now the every transaction we spoke has two aspects. One is on the debit side, on the credit side. So both aspects of this account are actually recording. Now while recording the when following the transactions, when recording this transaction double entry system, basically there are two methods are actually followed. One is a traditional method of accounting, other one is a modern method of accounting. Now let's look at what is a traditional method of accounting with an example. Okay. So under traditional method, there are three golden rules of accounting. There are two golden rules of accounting is applied, and these golden rules are applied for recording of transaction. Now let's say example, what are the three golden rules? Now three golden rules are based on three types of account. First, there is a personal account. So what is a personal account? Personal account denote the natural person or legal person. So natural persons refers to the persons like a Mr. A, Miss B, something like that, and the legal persons represents the entities. Okay, they can be a company, they can be a bank, or they can be an NGO, something like that. So personal account is the first type of account which denotes the natural or a legal person. Now what is the rule for personal account? Rule for personal account is debit the receiver and credit the giver. So you need to debit the receiver and you need to credit the giver. This is the rule which is followed in case of personal account. Now let's say for example, $5,000 received from Mr. B. So here what happens, the $5,000 is received from Mr. B. So the Mr. B is the giver here. So the transaction will be cash account debit, which is comes in, and Mr. B will be you need to credit Mr. B. So this is where Mr. B is considered as a giver, so he is actually credited. Now let's say for example, same transaction, let's say $3,000 paid to Mr. X. $3,000 paid to Mr. X. Now how this transaction will be recorded? Now if you look at here, Mr. X is the receiver of the benefit. So the Mr. X will be debited and cash will be credited. So this is how the personal account rule is actually applied under traditional method. So the first golden rule is for personal account, which says that debit the receiver and credit debit the receiver and credit the giver. Now the second type of account is real account. So real account is, what is real account? Real account denotes denote assets and liabilities. Okay. Now, what do you mean by assets? Assets are, for example, furniture, machinery, or any asset which are purchased. That is actually known as an asset which something an organization own. And liability is something an organization owe or they need to give. For example, loans which actually borrowed. So those are considered to be liabilities. What is the rule for real account? For real account, the rule is debit what comes in, and credit what goes out. So you need to debit what comes in and you need to credit what goes out. Now let us see what is the example for a transaction. Let's say, for example, ABC company bought furniture for $1,000. Now, if you look at here, ABC company which is bought furniture for $1,000. Now, if you see, furniture is an asset. Furniture is an asset which actually comes into the organization. So you debit furniture, and cash is also asset. But actually, what happens is when you buy an furniture, you spend out. So the cash actually goes out. So something which goes out, you actually credit it. So the entry for real account 1 year, the ABC company bought furniture. So what happens here is furniture is debited and the cash is credited. Now let's look at another example. Let's say XYZ company raised a capital of $10,000. Now let's say this is the entry. Now if you look at this, right, when the company raises capital, cash comes in. Cash is considered to be the real asset. So here asset debit what comes in. So cash is coming in. So you need to debit the cash for $10,000 and you need to credit the capital because capital is the expenses which need to be given back to them. So this is the entry for raising capital. Cash comes in, debit, and credit capital, which is a credit. So this is the second rule which says that it's a real account rule. The third rule which need to be followed is it's for nominal accounts. So nominal account. Now nominal account denote all expenses or losses and incomes or gains. So nominal account is used to record all the expenses or losses and incomes and gains. Now let's say, for example, rent paid. Let's say rent paid by cash. Let's say, for example, for $500. Now how do you record this one? Now rent paid, here the rent paid is a expense. It's an expense which is incurred by an organization. So the rent will be debited and it's paid through cash. So cash will be credited. This is the entry for rent paid. Now let's say dividend received. Now dividend is a income which is received. So the cash here will be debited and the dividend received will be credited. So this is the entry for recording the income. Now when it comes to traditional approach, they follow the golden rules of accounting where there is a personal account, real account or nominal account. Rules are applied while recording the transactions. The second method is actually called as a modern method is there. In modern method, what happens is the three headings are there: assets, liabilities, revenue or expenses are. Now whenever there is a increase, let's say, for example, how the rule is applied for assets. If there is a increase in the assets balance, okay, for example, let's say the company is already company have $5,000 worth of furniture and they are buying another $2,000 worth of furniture. Now if you see, the furniture balance is increasing from $5,000 to $7,000. Now since furniture is considered as an asset, whenever there is an income, whenever there is an increase in the asset, you need to debit it. And similarly, whenever there is a decrease in the assets, let's say the firm disposes some of the assets, then in such case you need to credit it. So for an asset, the rule is, the approach what they follow under modern method is debit the account for any increase in the assets and credit in case of any decrease. Liabilities. let's say liability is loan received or a loan borrowed. Now what happens in case of liabilities is any increase in the liability you need to credit it. Okay, let's say for example ABC company borrow loan from the bank. So here actually what happened is liability is increasing. So you need to credit the liability and you need to debit any decrease. Let's say if a company repays the loan, then it case will be decreased. Similar rule is liability rule is applied for capital also. So whenever the firm is borrowing the capital, the capital balance is increasing. So you need to credit it, and whenever they repay the capital, it is decreasing. So you need to debit it. Then revenue and expenses. Revenue, if there is an increase in revenue, you need to credit it, and if there is a decrease in revenue, you need to debit it. And in case of expenses, if there is an increase in the expenses, you need to debit it, and in case of decrease in the expenses, you need to credit it. So under modern approach, this is the rule which is followed under modern approach for recording of transactions. So while recording transactions, the companies can follow the traditional method where they follow 3 golden rules of accounting and record the transaction, or they can follow a modern approach and they can follow these 3 rules of assets, liabilities, capital and revenue and expense. They can apply these rules and they can record the transactions. Thanks for your time.